Welcome everyone to the webinar for pre-IPO tech employees, very specific. All right, so first off, let's talk about why we're doing this. I wanna make sure that we educate and then we help you plan, right? Obviously, like every situation is gonna be very specific and we're not gonna be able to give you specific advice, but I hope that through this webinar that you walk away with like a better understanding of maybe how to minimize taxes, how to make sure that you keep as much of your equity compensation as possible, and then diversify over time. Those are the really key topics that everyone brought up, all right, and that I really love and trust. And number three is, look, like Range, the company that I'm about to introduce, is not for everyone, but of course, no doubt about it, I hope that some of you watch this webinar and think, okay, maybe actually I'd love to meet with Dylan and the sales team and check out Range. If not, no worries, no big deal. I want to make sure that we educate and help you plan, but if you are interested in Range, I'd love to follow up with you afterwards. Cool, and so a little bit about Range and what we do. So we are an all-in-one wealth manager for high-income households. Strategy, tax filing, investments, estate planning, insurance planning, retirement planning, education planning, kind of all of it. What you traditionally hire a financial advisor, a CPA, an attorney, a life insurance person for, we do it all for a flat fee. All right, and so that's what we do, as well as cash flow and covered that, and equity compensation. Don't want to forget that one. All right, and then who is Range for? Who gets the most out of Range? It's high-income households with complex wealth. That can mean a lot of things. I would say probably the majority of people here I would consider high-income households with complex wealth, but complex wealth can mean anything from 2+ incomes, typically at least 250K combined. If you're in the Bay Area, New York, you're probably talking more 4 to 450 combined. You have equity, you have children, you maybe have an investment property, you have some kind of tax or investment complexity, right? Like, or you're planning for fire. We know a lot of people coming from the tech world specifically planning to retire in a few years, in their early 40s, and Gio can talk about that.
My name is Gio. I'm one of the senior planners here on the team at Range. I have a specialty within equity compensation and tax planning for high net worth individuals, high income earners. And really at the heart of what I love to do is help people navigate through really complex times of their lives, this probably being one of them, and how to make your wealth work for you in the most impactful way possible. So excited to be here. I've been doing this for over a decade. And look forward to just walking through what to prepare for as you enter into an IPO, what strategies you can consider, and then ultimately what your tax bill will potentially look like this year. So thanks for having me. So the first I want to talk about is restricted stock. So many of you folks in private companies likely have restricted stock that was awarded to them. If you have something called a double trigger, which means that it has to meet 2 requirements because it's yours. So the first of that being time. So you were with your company for a period of time. Once you hit that milestone, one set of triggers gets released, but it's not taxable to you yet. So what ends up happening is at IPO, you hit the second trigger, which is liquidity. And that means that anything that was time-based vested at the time of IPO now meets the liquidity event. So it all becomes taxable income in the IPO year. So pausing there, restricted stock, which works differently than non-qualified stock options or incentive stock options, those are taxable on vest regardless if you choose to keep or sell them. So in your situation, you're going to have a taxable event on IPO. If that occurs in 2025, anything that was time vested now hits the liquidity vest. You're going to have all of those years that could have potentially had your RSUs vesting over time into one tax year. The requirements are 22%. So that's what the IRS requires gets withheld on this income. So it's called supplemental wages. And 22% is what is the bare minimum. You may have the option to increase that withholding. It's unknown, every company does things differently, but just know that 22% may not be enough to cover your potential tax liability. So going through key challenges is what happens now. So I just mentioned, hey, you're gonna have a tax liability. Typically what happens post-IPO is there is a 180-day lockup, meaning that you cannot sell your shares for a period of time. That ranges from company to company. You want to plan ahead knowing, well, if I'm only having 22% of my shares sold and withheld for taxes, which will happen, how am I going to come up with the rest of it? So getting ahead of what your tax bill looks like in 2025, or 2026, depending on when the IPO occurs, you want to just know, do you have cash set aside and start planning early? Like I mentioned earlier, $100,000, let's say you had a bunch of shares vest over on time-based period earlier in your career. Now the liquidity part is going to happen. So all of those shares will come in. So if you have $100,000 of vesting in this calendar year, your W-2 will reflect $100,000 of income that we want to account for when thinking about your taxes. So a couple of planning tips. You typically can increase your withholding. Not all the time, so I don't want to say it's guaranteed, but you do want to think big picture. I have my income from my current employer. I have income if you have other equity compensation. What will my tax bracket fall into? If you work with an advisor, a tax planner, whomever it may be, they should be able to run you a projection and give you guidance as to should you increase your withholdings. What this will happen is rather than them selling off 22% of your shares that vest and are subject to taxation, they'll increase it to 35 or 37. Just keynote, 37% is the highest you can go. That's the current top tax bracket.
It would just be company specific. So basically what it is like if you want to plan ahead and you don't want to have a large tax bill at hand, and if you're able to actually increase the withholding where they would potentially withhold more on IPO day, that would be one potential planning option.
Exactly right. If you cannot, or even if 37% is not enough, everyone is in a different financial situation. Tax planning is not one glove fits all. You do want to plan for cash needs to cover that tax shortfall. Now that's going to be key here because if there is a 180-day lockup, and like I mentioned, that varies from company to company, you would not be able to sell these shares to cover the potential tax bill. So you don't want to be stranded at 4/15, the tax deadline, trying to come up with cash to pay a big tax bill. Getting ahead and knowing what you have or what your taxable income will be key here.
If you owe a big tax bill and 4/15 rolls around and you're still locked up, can you extend to October 15th, even if it's a huge tax bill, or is there a penalty for doing so?
So unfortunately, there is still going to be a penalty. Filing an extension, which would give you to 10/15 to file, only is for your filing requirement, meaning that you file your tax returns. Your tax bill would still be due on 4/15. What ends up happening is you can go on a payment plan, or you can make an estimated payment that you apply towards your extension with your best guess possible. But extensions will not allow you to extend when the actual bill is due.
Got it. So you better have the cash on 4/15.
That's correct. So that's why you want to plan early in case there's other levers you have to pull within your financial life to cover this tax bill. Importantly, you want to make sure you meet the safe harbor. What that means at a minimum is that you have to pay in by year end or by January 15th via estimated payments at least 110% of last year's liability. That's
2024.
Of 2024, correct. So you would take 2024's tax liability. Let's say it was $100,000 that you owed in taxes. By January 15th of 2025, you need to make sure that you paid in at least 110%. So that would be $110,000. That will not eliminate your tax bill due when you file your taxes, but what it does avoid is underpayment penalties. So the IRS has this funny rule that you get hit with underpayment penalties if you don't pay enough in throughout the course of the year. In big income years, you want to make sure that you hit that liability amount. You can do it via increasing your withholdings on your paycheck or estimated payments. That will vary from person to person, so it's very important to work with whether it's your CPA, your financial planner, your tax planner to make sure that you're hitting the right requirements.
So
I think you might want to calculate what the fee is for late payment, because typically it's not that high. I think it's on the order of 2% or something that you owe. So that way you could basically delay it until October and just pay the penalty.
That's exactly correct, which is why you want to work with the tax planner. Although with interest rates increasing, they have increased that penalty of underpayment from 2%. Now it's ranging where current rates are around that 6 to 7%, which changes things for some people. But again, it's a personal preference. Some people are very adverse to paying penalties if they don't have to. It's something you'll want to map out. Should I keep funds aside in a high yield savings account earning 4%, or should I pay it outright to make sure I meet that? So that's very person specific.
Thanks, Jan. I didn't realize the penalty was so small. What I was going to ask is, if there are windfalls occurring in Q1, Q2, Q3, is meeting this safe harbor sufficient to avoid penalties, or do you also need to pay estimated taxes in those Q1, Q2, Q3 quarters?
That's a great question. Technically, by the IRS, you need to pay those estimated payments as the windfall is happening. However, the way you can work around that is you can increase your withholdings on your current pay stub. If you have a W-2 employer, you can increase your withholdings so much that you cover the safe harbor. Even if you do that by year end, it's a loophole in the IRS tax system. They apply it as if those payments are treated equally throughout the course of the year. So if you're making estimated payments, you want to pay them as you're earning the income. If you're going to increase your withholdings to avoid those underpayment penalties, the IRS treats them whenever they're paid in, if they're done equally throughout the course of the year. So even if you did all of them in December, they'll annualize it for you.
So if you increase your withholdings, as long as you get to that 110% of prior year over the course of the whole year, then you'll be free of penalties for not paying estimated taxes.
That's exactly right.
It was done through withholdings.
That's exactly right.
Okay, cool. Thank you.
Yeah, I thought that was. I learned that as well. I didn't realize that specific nuance, so I thought it was very interesting. Because what you're saying is you're probably going to have a lot higher tax bill in 2025 than you did in 2024, but you can save yourself on the interest and penalties if you just make sure you meet safe harbor.
Yeah. Okay. Cool.
Yeah. Thanks for the questions.
So let's talk about non-qualified stock options. So these were awarded to you that you're given the right to buy stock at a predetermined price. So if they have vested, nothing happens. Differs than the RSUs, which say that the day they vest, they become taxable income to you. With your non-qualified stock options, when you exercise, that's when you are starting to generate income. And the income that will be for you is the difference between whatever the strike price is and whatever the share price is on the date that you exercise. So you can control how much income you want to generate by when you choose to exercise these options. You're not forced to trigger a taxable event. So if there is an IPO and somebody holds non-qualified stock options, there is no tax impact until you choose to exercise them. Just going through the tax treatment, which we already talked about, it is going to be considered ordinary income. So you will have to plan for it. You can exercise and hold the shares, meaning that you choose to buy them at the discounted price and you hold on to them, or you can exercise and sell. Regardless, typically what will happen is there will be withholding that still applies here, and it will be that 22%. So back to what we were talking about with RSUs, it may not be sufficient for you. So if you have your double trigger RSUs that went off, so you already have a ton of income and you want to exercise more stock, regardless if you exercise and hold or exercise and sell, you're still going to get triggered with ordinary income on the date of exercise. In terms of holding periods, it changes, but you typically don't have a certain holding period that you have to hold on to. The lockup may differ, right? It depends on whatever someone's lockup is. But compared to incentive stock options, there's no reason to hold these.
I believe for the 110%, you can also make an estimated tax payment towards the end of the year that brings you up over the 110%. Doesn't necessarily need to increase the withholding, but there's some special cases around that. But might want to check with the CPA.
That's exactly right. And that's why I was mentioning that, yes, you can make that payment in the fourth quarter to bring you up. But if you earned income earlier in the year, you may still get hit with some underpayment penalties. It's something your CPA would be able to work through with you. There's certain forms you can file to certain as annualizing, but it's not a guarantee that you'll eliminate all underpayment penalties. Now, what happens with non-quals? You don't have to exercise them. You have until an expiration date, which is typically 10 years post the day that they were granted to you, to exercise. So if you know you're going to have a high income this year, you may not want to exercise them. It depends on your cash flow needs. It depends if you want to exercise more income. It's very personal to you and your financial plan. If it goes off this year, right, that may be something you say, you know what, I'm going to wait until next year. Because there are no additional benefits for holding post-exercise other than potential capital appreciation, but you want to make sure that you're diversified. You can use these for liquidity, exercise and sell, take the funds, use them to reinvest into a different portfolio, fund your children's education goals, buy another home. It's very dependent on you. The good thing about having the option or the optionality, I should say, to choose when you want to exercise, think about, when is my expiration period? When is my expiration date? You can come up with a plan to exercise X amount each year relative to your personal plan, your personal tax goals, to make sure that you're not triggering too much tax, you're staying in a tax bracket. But the key thing here is look at when these are set to expire and plan around them. You don't have to exercise everything all in 1 year so that you bump yourself into a really high tax bracket. Or if you're in the top tax bracket this year, maybe you're in a lower one next year, you may want to hold off. But you may want to also say, I'm going to do a little bit each year and not wait until the last day to do it. Now, I mentioned this already, just coordinate it with your overall tax bracket to make sure that you are, and not even just in this year, but in future years too. Think out what your income may look like 26, 27, 28, and then bring your plan starting, looking out forward, bring it back each year you come up with the tactical advice.
It's a lot more straightforward, to be honest. Like going through RSUs is a lot more complex. You're getting hit with taxes, but like NSOs, the reality is like what I didn't realize is like you have the option just to delay that if you want to, and you can hold off on the liquidity. But I thought that was interesting. Cool. Let's go over to ISOs.
Now, ISOs. So these similar. This is going to have a little bit of a different tax impact potentially, and it depends on if someone has already exercised them or if they have not. So similarly to your non-qualified options, there is no tax event at IPO. It's when you choose to exercise them. It's same thing. Exercise, it becomes a taxable event at exercise. Now, the difference here, though, is that there's something called AMT that could potentially happen. So when you exercise incentive stock options, the spread between your strike price and the current market value is what will not be counted towards regular income, but something called alternative minimum tax. It's a parallel tax system within the United States that makes sure that high income earners pay a minimum amount of tax. It was created years ago, and at a high level, that's what it means. So when you're exercising ISOs and you're holding them, so we'll work under the assumption you exercise and hold, you will generate income for AMT taxes, but not for regular taxes. Now that becomes a big focal point for folks with ISOs because there's actually a threshold where you can exercise a certain amount usually without triggering any AMT. And that AMT income is based on the spread between the current market value and your strike price. So I want to pause there because that's a little bit different. Any questions so far?
I think AMT was one thing that I struggled with. I got hit with AMT in the past, but I guess the flip side of it is if you do pay AMT in the year that you exercise those ISOs, you get it back potentially in future years as a tax credit.
That is correct. So if you have paid AMT in the past, so let's say some of you folks have exercised your options in the past before, you paid your AMT, you have a credit carry forward. Now you need to make sure that your accountant is actually tracking it on a year-to-year basis. You need to file a certain form with it. And in years where your regular tax is higher than AMT tax, which by the way, AMT tax is calculated each year. You usually just don't see it because it doesn't apply to you. But you can use that credit to reduce your taxable income down to the AMT number each year until you run out of that credit.
Cool. Let's talk about the qualifying disposition.
Yes. So ISOs work a little bit differently than non-quals where there are no holding requirements. There's actually something called a qualifying disposition and a disqualifying disposition. So if you exercise and hold your stock options for at least 1 year from date of exercise, 2 years from date of grant, and then you go to sell it, what you will end up paying is long-term capital gain rates on the spread, which is the strike price and whatever the price is at the date of sale. So for AMT purposes, it's the spread between strike price and price at date of exercise. For long-term capital gains, which is ultimately what you want to pay, you want to exercise enough to potentially avoid AMT, so you don't pay any tax, and then eventually at sale you pay long-term capital gain rates. You would have to hold for at least 1 year post date of exercise, 2 years post date of grant. Then the gains are taxed at long-term capital gain rates, which federally are either 15 or 20%, compared to your ordinary income rates, which are 37%. So the other question is, well, what happens if we have a disqualifying disposition? This means that you exercise and sold. So for example, you want to treat it like a non-qualified stock option. You exercise and sell same day, or you exercise and sell within 6 months. Then the spread just becomes ordinary income. You don't get those favorable tax treatments. So you do have a lever to pull. If you say, you know what, I still need the cash, I'm going to give up the preferential tax treatment. But if you want to hold them, these would be something that you would exercise and hold to get that potential tax preferential rate. And if you plan accordingly, you may even be able to exercise enough while the spread is smaller. So you'd want to exercise when the difference between the current market value and strike price is smaller, so you can exercise more, because there's actually a calculation that goes into it, which is how much income can I generate under AMT for these ISOs without triggering any AMT? And I spend a lot of time working with members on that, which is let's exercise X amount in a given year because you won't pay any AMT, you will hold on to them, you'll sell it in the future, and it's a little bit of a tax planning strategy. It's a little bit of arbitrage. So let's talk about what you should do with your ISOs, because this is actually where there's some planning if you have them. Like I mentioned earlier, The spread on exercise, your strike price, and your current market value is AMT income. If you anticipate that your price of your stock is going to go up substantially, and this applies to anything, you'd want to exercise now because the spread is smaller, which means you would report less income under AMT taxes, which potentially means you can exercise more without paying more income. And it starts your holding period clock. So even if you exercise today, you'd still have to hold it for at least a year at minimum, because you have to hold for 1 year post-exercise, 2 years post-grant to get the tax benefits. So if it makes sense to you, should you exercise now while the valuation is lower? Maybe. This is not specific advice. It's dependent on your certain situation, because there's some issues that could happen. If your company is still private, you're buying that stock with no liquidity right now. So if you put in, let's say, $20,000, you say, I'm going to purchase my shares now, it's not going to trigger any AMT for me, but an IPO gets delayed or the lockup period is longer than anticipated, you will not have the liquidity from these shares. So as long as you have cash flow to support your lifestyle, it matches your tax needs, it fits in with your broader goals, consider exercising pre-IPO. But again, that's very specific to each person.
And the flip side would be that, well, we know the valuation is, I don't know what the valuation is now, but like it could go lower post-IPO, it could go lower post the potential lockup period. So I guess there's risk on both sides.
That's correct.
Important to point that out.
So once you are post-IPO and it's a public company, you can still exercise and hold. You would just want to be mindful of your holding period requirements. Post that, you also want to make sure that you are cognizant of what Tony was mentioning, right? The share price could potentially be volatile. We know that when companies go public, no matter the company, history shows that it is a volatile time period. So if you are going to exercise, you can still do it post-IPO. Just be mindful of the spread at that time in case the share price goes up and down. And those are what you want to potentially hold on to for long-term capital gain rates, if you can. Like I said, you have the lever to pull that you can sell it once it's a public company. But in reality, if you wanted to segregate your stocks into different buckets, ISOs are something you'd want to consider holding long-term, while your non-qualifieds and RSUs are something you'd want to sell, if not immediately, but there's not as much tax benefit for holding on to them.
Yeah, we had a conversation a couple weeks ago when we talked about the 3 different types of equity, like we just talked about, because I have all 3, and I hadn't really thought about how I would think about the ISOs as that bucket that I would potentially hold on to for longer versus the NSOs or RSU, just because of like the liquidity needs, and then what happens potentially selling those, on whenever we can sell them versus hanging on.
And then the other thing is ISOs, just like your non-quals, you can exercise them strategically over a period of time. These 2 also have an expiration date. So think about how much AMT should I recognize each year? Can I exercise X amount each year to avoid AMT, knowing I'm going to hold on to them? Now, all of this is working under the theme that this is specific to each person. Tony, if I had ISOs, right, my situation may differ from Tony's. Every client I work with has a different unique circumstance. These are high-level tips to think about as you're going into a potential time in your period where your company is going to go public.
Go ahead.
Is it common after you leave a company, after you stop working there, for your ISOs to convert to NSOs?
Yes, usually within 90 days. This is really... There are complex transactions, and the tax ramifications behind it are confusing. I've been doing this over a decade, and it took me a while to get them.
Should I sell/hold? And then how should I diversify? Right? I'm sure that's like the main common thing that members ask about. So we wanted to specifically answer this.
So I like to say diversification is always asking for forgiveness, right? It's saying you don't know what the future is going to bring for your company. But you want to start with your goals. So think about how this fits into your overall plans. Do I need the cash? Have I been waiting for this event to happen to do that extra thing in my life, travel the world, take a sabbatical from work? Think about your personal goals and where this fits in now that you have the potential to sell them. Now, I already mentioned this, but concentration risk is a very specific area for people with equity comp, because over time, part of your compensation was in equity of the company. You now have likely a substantial amount in one company. It will create wealth. A concentrated position usually does create wealth, but diversification is what's going to preserve it. So one is that you're now subject to share price volatility. And if something happened to the company, you could lose your income. So you want to think about, how do I spread this wealth out so that it's not all my eggs are not in one basket? Diversification is actually where this comes in. So you will want to consider selling a portion. How much you want to sell is going to be very dependent on you and your conversations that you have with your financial planner or your tax planner. And one of the easiest ways to diversify is as your RSUs vest, or as the lockup period comes, or if you still have RSUs that are vesting. Those are income regardless if you keep or sell them. If you keep them and it vests at $100 and the share price goes down to $90, you still have to pay tax on that $100,000 even when you go to sell them. The loss you'll be able to generate will be called a capital loss at that point, but you can't offset your income dollar for dollar. So diversification is something that you want to make sure that you are considering so that you don't have your good days and bad days tied to your company's price. In terms of timing, you also don't have to sell all at once. One thing I say time to time again, I'm never going to tell you to bring your exposure down to zero, but let's come up with a plan to sell it down over time and reinvest into the S&P 500, bonds, large companies, mid, small. Think about gradually decreasing your exposure. And the reason why I like doing that, as I mentioned at the beginning, diversification is always asking for forgiveness. If your company does really, really well, you're going to hate me, right? You're going to say, well, I missed out on that upside. But if it did really, really bad, I'm going to be your best friend. So by selling down over time, you still have that exposure while now starting to build another portion of your portfolio that is not specifically tied to one single company.
So the idea of creating wealth through concentration and then spreading out that wealth and diversifying for a longer time period is probably the hardest thing.
It is, and look, you believe in this company. It becomes to be psychological, which is where you can come up with in your periods of your mind, if the price goes to X, I know I'm selling. If the price goes here, I know I'm selling. You can preempt what your parameters are so that you are not stuck with making a decision during the time period where the price is really low or really high.
And the last one is just about liquidity.
Yep, so you now are liquid. This was a private company, and this happens with a lot of folks who have private equity in private companies. You did not have the opportunity to sell when you wanted to. Look at the share price from time to time. Think about that plan in advance to know that you can actually take your chips off the table from the wealth that was created within your single company.
Cool. And then the second question was, how do I reduce taxes on my vested RSUs?
At a high level, as W-2 employees, your hands are kind of tied behind your back. There's not a lot that you can...
That wasn't the answer I was looking for. Yes.
But there are still things that we can plan for. So this will be W-2 income. If you're not an employee, usually they'll issue you a 1099 NEC, but that does not matter. It's still going to be taxed the same way. Ordinary income like W-2 income. So first you want to understand what are you going to owe this year. So that's done with a tax projection and a withholding check. So how much am I going to owe based on my double trigger RSUs that are going to go off, any other equity comp that you have, your current employer's compensation that you're earning. Understand what your overall tax bill is going to be. And then say, well, how much have I withheld year to date? How much is going to be withheld from this event for me is going to be the 22%. Can I increase my withholdings? See where you fall there. Like we mentioned earlier, you could underpay and there's a penalty, and we already discussed that penalty may be minor, but some people are very conscious of that. You don't want to pay it. But so the first step is, how much am I going to owe and what am I withholding? This is a perfect opportunity to maximize your pre-tax contributions. So through all employers, the typical benefits that are involved are your 401k plan, HSA, FSA, dependent care. Different employers offer different plans. If you're an executive, sometimes there's a deferred compensation plan. Take advantage of those pre-tax contributions that you can make, because this is the year you want to get your tax bill as low as possible. Think about it this way. If you fall in the 37% tax bracket, every dollar that you're putting into a tax deferred strategy like a 401k and HSA and FSA, you're saving 37 cents, right? So it's actually pretty meaningful in terms of what you're paying on it.
And if anyone, I don't know if anyone here now, self-employed or started their own business, a SEP IRA and solo 401k could be a way to even take advantage of that big time. Right?
Yes,
huge numbers.
Absolutely, absolutely. If you're charitable, this is a good year to bunch your donations. So I'll spend some time thinking, when you go through your filing your taxes, you either take the itemized deduction or the standard deduction. Standard deduction is this year is $31,500. You get that if you're not itemizing. If you're over 65, you can get a little bit more, but I don't want to go into too much detail there because it's really just age dependent. If you are itemizing, you can itemize your mortgage interest. You can there's a limit, so you can only up to $750,000 of your mortgage. You can take an interest deduction on it. local and state taxes, but that's capped at $10,000. Now, under the new bill that just went into effect, they did increase that cap to $40,000, but there is an income limit, and there is a potential that if you're over $500,000 of AGI, what you actually are capped at comes back down to $10,000. So I'm going to work under the assumption that you have a $10,000 SOLT limit this year. And then on top of that, you can do charitable deductions. If you are charitable, one thing you may want to consider doing is making more than usual charitable donations. So you bunch them all into this current year. So between that deduction, your mortgage, your state and local taxes, you get a bigger deduction in the high income year because it's going to be more meaningful to you. Now, you can do that by donating securities. So donating, if your company, once they go public, allows for it, you can donate your appreciated securities so you don't have to pay capital gains tax. You can donate other appreciated securities. There's things called donor advised funds that you can create. And it's a way to take advantage of the deduction this year while you're in a high income bracket. So it's just a way to bump up your itemized deductions. Now,
tax loss harvesting, we all know very well.
Yes, tax loss harvesting.
That's an obvious one. Look, if there's a way that you can offset these gains or income with tax loss harvesting, now's the year to potentially do it.
The only thing there is if there's no capital gains, which most of this, especially RSUs, are going to be W-2 income, you can only use up to $3,000 to offset your income. If you have other gains, they can offset it dollar for dollar, but you're not going to get too much of a tax hit there if it's all W-2 income. The other thing is going to be review your taxes. So are there more deductions you can take? Like I mentioned, accelerating your charitable deductions. If you are a business owner, if you're self-employed, can you increase your expenses this year to lower your profit from your business and potentially generate a loss? Any losses from a business that you're actively employed in can offset your income. So it's a great year to consider if you're self-employed. Hey, do I have any extra expenses that are going to push off till next year? Can I accelerate them to 2025 to generate a paper loss so that I can offset my income?
I was wondering if you guys know whether or not you could donate shares during the lockup period. I know you can't sell, but are there any rules against donating?
That's a good question.
I think it's going to be very company specific, and it's something you'll want to inquire with your employer about. The good news is you have until 12/31 to make that donation, so we don't have to figure that out right now, and for it to count for the 2025 tax year.
Hey, sorry if I missed this earlier, but in the case of NSOs, I know you mentioned with RSUs, you can, like, the default is 22% withholding.
Yeah.
You can maybe adjust it. And I think you said for NSOs, the default is also 22%. Is there a way to adjust that withholding for NSOs as well? Or is it kind of just set at 22%?
Nope, that's a great question. That is exactly right. If you can adjust it for your RSUs, usually it will apply to all types of equity compensation. You'll want to confirm when you make that a change, but it can absolutely apply to NSOs as long as your employer allows for it.
All right. Thank you, everyone. That was incredibly successful.